Hello and good evening, everyone. I am Mansi Kanekar, working in the Investor Education Department of NISM. NISM is a capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in five broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is Bonds as a Portfolio Tool, Positioning Fixed Income for Balance and Growth. So, for this, we have with us Sanjeev Kumar, co CEO and founding member, BondView. Mr. Sanjeev Kumar is a seasoned finance professional with over 25 years of experience in India's financial markets, specializing in fixed income, wealth management, and capital markets. He is the founding member and co CEO of BondView, a SEBI registered online bond platform focused on democratizing access to fixed income investments for Indian investors. Over the course of his career, Mr. Kumar has held senior leadership roles at leading financial institutions including L&T Mutual Fund, Tata Mutual Fund, Bajaj Capital, and SREI, where he played a pivotal role in building and scaling both retail and institutional fixed income businesses. So, I would request Sanjeev sir to begin with the session.
Thanks, Mansi, and thanks NISM team and NISM for giving me this wonderful opportunity to basically present the topic, which is the topic in vogue because market is extremely volatile, and in this market, people are definitely craving for some of the instrument which provides stability to the portfolio. So before I start, I will just first share my screen. Just give me 1 2 minutes. I hope my screen is visible.
Yes, sir, it is
Yeah,
visible.
great. So basically, the entire presentation, if you remember, last in January, on January 6th, we presented our first webinar, that is, providing stability to prosperity, how we can basically provide stability to the portfolio. This presentation or this webinar is just a sequel of that, and basically there will be four series which we will be basically conducting along with NISM, and probably it is very important for us to understand uh, each the topics, each series, because that will basically give you the overall backdrop of fixed income and practical application of fixed income. So first session, if you remember, अगर आपको याद हो तो we basically capture from stability to prosperity, reframing fixed income in portfolio thinking. There we spoke about mindset and role of bonds. The second session today is just the sequel of that, where we will talk about portfolio construction, and we'll also, while I'll be presenting the presentation, I will also recap the last presentation which we basically presented to our target audience. And then definitely in March and April, the sequel will be basically the optimization of fixed income portfolio, and session 4 would be the application of fixed income. So today's session is all about the structure of fixed income portfolio, how you can basically structure the fixed income portfolio, and which can provide basically balance and growth. It is very important for us to understand. If that is the case, then let's recap the last webinar, which we basically presented in January. And as I mentioned, that webinar was, or that topic was, all about mindset and role of bonds. What we covered in last presentation, it was basically we presented about the investment landscape. It is very important for us to, whenever we are investing, it is very important to understand what are the products available, and what are the risk involved, commensurate risk involved with that particular product. So we covered that. हमने ये भी कवर किया लास्ट प्रेजेंटेशन में कि आई थिंक देयर इज अ मिथ इन द मार्केट दैट इक्विटी विल ऑलवेज is a wealth creator and always create wealth. I think that is we challenge that view, and we spoke about that. Yes, equity can create wealth, but it is equally important for us to understand the volatility attached to equity. So volatility destroys behavior driven wealth, so we spoke about that. Then we spoke about कि जो wealth जो बनता है वो wealth basically wrong asset uses के कारण wealth का destruction होता है. It is not the uses of asset. Then there we cover that, and we basically identified 4 or 5 kinds of the portfolio for various class of investors. Then we spoke about कि अगर आप अपने portfolio से if you are generating 10 to 12% CAGR at portfolio level, that will be exceptionally good. More often than never, the people talk about 18%, 20%, 25%. In one-off case, you may make, but at portfolio level, the making 10, 12% return is exceptionally good. We spoke about that, and we basically presented the case in detail. And then we spoke about that, if we really want to manage our portfolio, there should be some science, there should be some scientific framework rather than chasing the returns. And while we spoke about, I think I was, hello, Mansi, can you hear me?
Yes, I can hear you.
I was on mute or what?
I guess the few seconds
Oh,
before.
okay,
I
no,
guess for 5 seconds mostly.
okay, no problem, no
I'm
problem.
not
So
hearing.
is it audible right now?
Yes, yes, sir. You're audible.
Okay, fair, fair. So, so we spoke about this the series, and we spoke about basically the I was talking about the recap of the last webinar. So there, basically, as I mentioned, that we spoke about investment landscape, we spoke about volatility. We also spoke about that, majority of the time, because of the wrong asset uses, you destroy wealth. We spoke about, generating 10 to 12% CAGR at portfolio level is very, very important, is exceptionally good. And we also spoke about the scientific framework. And in that parlance, in that context, we spoke about that bond should be central in one's portfolio. Today, while we gave the key message that equity builds wealth and debt protects wealth, and if you are protecting, the drawdown, that really helps you to basically have a right degree of compounding. And if you have got right degree of compounding, then definitely that can create a prosperity. So this was basically the sum and summary of the presentation which we did last time. While we move ahead, I just want to run one poll. I just request NISM team to run the poll. The question is that what worries you more? What worries you more as an investor? The choices are a market volatility, low returns, capital loss, and missing out on rallies. There is no right and wrong answer. I request all the participants to basically answer these questions, answer the question. What worries you more as an investor? That will really help you to understand the entire context of fixed income portfolio and construction of fixed income portfolio. We will just take 30 seconds.
Sir, I am sharing the results of the poll.
Yes, you can share the result.
Yes. So 29% of the attendees have selected A option, 17% of the attendees have selected B option, whereas 40% of the attendees have selected C option, and 14% of the attendees have selected the D option.
So if you see the answer, I think it is scattered, but most important is that because of the capital loss, what worries you more is the capital loss. This is the basically typical behavior that we have seen in any investor. So if that is the case, then let's understand the mathematics. It's very simple mathematics, which we have studied, the percentage formula we studied in our school days, but let's understand the mathematics. And in that context, how we can construct fixed income portfolio, let's understand that. So for example, there is a math of drawdown. For example, if you have got a portfolio where you have got 100% equity versus a portfolio where you have got 70-30 equity and debt. एक आपका पोर्टफोलियो है जहां पर आप 100 रुपए आपने इक्विटी में डाले हुए हैं, और एक आपका पोर्टफोलियो है जहां पर 70 रुपए आपने इक्विटी में डाला है और 30 रुपए आपने डेट में डाला है। और अगर मार्केट 30% ड्रॉ डाउन होता है, 30%, लेट्स पुट मार्केट मार्केट गिरता है, सो हाउ द सिचुएशन विल हैपन। अगर आपका 1 करोड़ का इन्वेस्टमेंट है, इफ मार्केट फॉल्स बाय 30%, योर प्रिंसिपल विल बिकम 70 lakh of rupees. The simple mathematics is that it requires 43% return. You have to generate 43% over 70%, 70 lakhs to recover your principal amount. While if you have got a portfolio which is 70-30, means 70% in equity and 30% in debt, then your portfolio will only fall by 21%. That will go down to 79 lakhs. So it requires only 27% from 79 lakhs to recover the principal. What does it mean? It means that debt reduces the recovery burden. If your portfolio is in the right framework, has been made in the right framework, right allocation agar aapne kiya hai, so then the debt reduces the recovery burden. And that is the real the magic, where if you reduces the drawdown, that really creates the right degree of the compounding. So it is this mathematics is very important to understand for any class of investor. And typically the myth that you only invest in equity and you don't invest in debt, that is a myth. Because if you really structure the portfolio in a manner which is commensurate to your risk-taking ability, it basically reduces your recovery burden. So what does it mean? It means that there is always a place for bond in your portfolio, because bond, as we know that market, equity market is always cyclical in nature, and it is basically prone to volatility. कोई ऐसा market नहीं है जहाँ पर volatility नहीं है. We have seen last 25 years, 30 years history. I think we have seen, some of you may be in this market for last 5 years, some of you may be in this market for last 10, 15 years. We have seen various cycles. One thing is very permanent in market is the volatility. And to attach to that, if volatility is there, in that situation human behavior is fragile. So ये तीन चीज जो है वो constant है, और ऐसे अगर ऐसा चीज अगर constant है, and if you really supplement your portfolio with debt, then basically it reduces your drawdown depth. It basically helps you to or ensure you that you don't make emotional mistakes, and it also reduces your portfolio instability. So if that is the case, then there is definitely a place for bonds in your portfolio. And while so, let's run the second poll. Let's understand, because as I mentioned that अगर drawdown को अगर समझना बहुत जरूरी है, बिकॉज उस ड्रॉ डाउन को अगर आप कटेल करते हैं तो आपकी पावर ऑफ कंपाउंडिंग, डिग्री ऑफ कंपाउंडिंग बढ़ती है, विच बेसिकली हेल्प्स यू टू create right amount of the wealth, optimum amount of wealth. Let's run the second poll and understand the emotional tolerance. What happens when really portfolio falls 30%? We have seen, I think in last year also we have seen the volatility. Last year also we have seen the volatility. Definitely the degree of volatility has gone has reduced considerably, but volatility is permanent. तो second the poll जो मैं run कर रहा हूँ, that will measure the emotional tolerance of any investor. So the question is, if your portfolio falls 30%, what you likely to do? You stay invested calmly, you feel anxious, but you hold the portfolio, you reduce your exposure of equity, or you exit partially. Let's understand what is your mindset. While after 30 seconds, you can just showcase the result.
Okay, sir.
Yes, you can show the result.
Yeah, so 40% of the attendees has selected A option, whereas again 40% of the attendees has selected B option. Then 14% of the attendees has selected C option, and 5% of the attendees has selected D option.
So while, in last couple of years, because of the huge inflow of retail money, people definitely, I think, they tend to, invest more. They stay invested calmly. They feel anxious, but hold the portfolio. But more often than ever, that is basically our experience. And we have run this survey. We found that I think most of the retail investors, or by retail investors, some of the informed investors also, they create panic and they tend to exit. Some of कुछ तो portfolio वो exit कर जाते हैं. That is basically the summary or the result that we have seen. So what does it mean? It means that अगर आपका portfolio में अगर debt है, if you have allocated debt to your portfolio, then basically it will reduce the risk. एंड अगर वो रिस्क आपका रिड्यूस होगा, आपके ड्रॉ डाउन कम होंगे, तो आप पैनिक में अपने पोर्टफोलियो को यू विल नॉट एग्जिट from your portfolio, will not do the mistakes, the emotional mistakes, which typically some of the investors, or more often than never, most of the investors, they do. So that is the basically very important for us to understand. And hence, the after second poll also, it is clearly evident that there is a place for fixed income in one's portfolio, and debt allocation very, very important, while building the right kind of portfolio. So while we have understood the mindset and the behavior of investors, let's understand, because today's topic is how you can create or how you can construct the portfolio. So it is very important to understand, for we to understand that how can one participate in debt market, or how we can participate in bond market. So as you know, I think I will just keep it very, very simple, because majority of the audience who have joined, they definitely they love simplicity. So if you see, there are two ways by which you can participate in fixed income. One is basically direct investment, and second is through mutual funds. We have been seeing in basically equities में भी अगर आप participate करते हो तो दो तरीके होते हैं. या तो आप डायरेक्ट एक्विटीज में पार्टिसिपेट करते हो, या थ्रू म्यूचुअल फंड के थ्रू आप पार्टिसिपेट करते हो. सिमिलर द माइंडसेट एंड सिमिलर थिंग्स आर इवॉल्विंग इन फिक्स्ड इनकम ऑल्सो. अगर इफ यू वांट टू रियली द पार्टिसिपेट इन फिक्स्ड इनकम मार्केट, देयर आर टू वेज बाय विच you can participate. One is the direct bond investment, and second is through mutual funds. When you invest in directly in bonds, then definitely there are challenges. But typically, I am talking about evolved investors, or investors who know about it. Typically they can invest in G-Secs directly. They can invest in state government bonds. They can invest in PSU bonds. They can invest in AAA rated bonds. They can invest in AA plus, AA minus, A plus, A minus kind of bonds. That is a rating. And or they can select few high yielding bonds, and they can participate in one of these, the bonds, or they can create a combination of, bucket, and they can invest in these bonds. That is the one way of investing. The second way of investing is basically through mutual funds. As you know, there are various class of mutual fund. In next slide, I will talk about, the various class of mutual funds, and which class of mutual fund is basically suitable for what kind of investors. So that is the second way of basically participating in fixed income market. Typically, what we have seen, there is no science behind it. I think most of the investors, they invest in direct bond investment, or they invest in mutual fund. They don't follow the framework. So when we will be basically presenting here, will be creating a portfolio, construct the portfolio, will create a framework for that. So if you invest directly in bonds, typically you can invest in 6-8 kind of bonds. Basically you invest in. Or if you basically participate in mutual funds, they are fund managers, basically they buy the bonds on your behalf, and there are typically 25 to 50 bonds depending upon the size of the funds they participate. So these are the two basically ways by which you can participate in fixed income. Let's understand first participation through mutual funds. So if you participate through mutual funds, there are basically in mutual funds, there are typically 16 categories depending upon the risk-taking ability of investors, or depending upon the typical time duration, you basically, select these, the funds. So for example, on risk return framework, the lowest risk is overnight fund, but typically here, if your time horizon is just a 1 day, 2 days, you can invest in overnight funds. While if you go to, let's put another gilt fund, which is the 14, number 14, row number 14, if your time horizon is basically long time horizon, and if you feel that, the interest rate जो है वो नीचे आने वाला है और वहाँ पर आपको appreciation का भी benefit मिलेगा, typically you go for gilt fund. So depending upon your time duration, depending upon what kind of risk you are taking, you can basically select these bonds and create a portfolio. So the type of funds, I just, for the benefit of you all, it starts for overnight fund, then it goes to liquid fund, then it goes to ultra short term, low duration, money market, short duration, medium to long duration, and so on and so forth. Here, the typical time duration is from 1 day. For overnight, liquid fund is up to 91 days. For short duration, it is 1 to 3 years. So depending upon आपका time horizon क्या है, you basically select these funds and invest there. Or any class of investors, उनके जो time duration होते हैं, depending upon their risk ability and their need, that varies. So you basically create a portfolio accordingly. Let's see, how the fund managers, what fund managers are doing. So typically fund managers, they utilize these three levers to basically manage the funds. That is, the levers are duration management, the second is the credit spread positioning, and third is the yield curve strategy. Means अगर किसी का पैसा अगर suppose कीजिए लंबे समय के लिए है, तो definitely they basically invest in higher tenor bonds, and definitely, they take advantage of credit spread, because as you move up the curve, you get the yield kicker, and they also, take advantage of the yield curve strategy. What is the spread between, the various class of, the securities. So yeah, these three levers basically fund managers use, and they manage the fund. Let's see. I'll just showcase 4-5 examples of some of the funds that will give you some sort of context that how the fund managers are managing the various class of or various funds. For example, if you see, this is just the average the portfolio asset allocation we have taken. So for example, if you see liquid fund, as I mentioned that in liquid fund, the time duration is for 91 days, and for typical time duration, and for short duration, I have just taken 5 the case out of the 16 17 funds that I have showed it to you. So liquid fund में अगर आप देखें तो यहाँ पे typically 91 days का time frame है. Short duration fund, where your time duration may be 1 to 3 years. Corporate bond fund, here the time duration may be 3 to 4 years, and so on and so forth. If you see this, the various, the column, various assets are there. The sovereign bonds, T-bills, AAA rated bonds, AA plus, AA minus, and as we progress, we can see, lower down the curve, various, the securities are there. And on the last, the column, you see the average portfolio maturity that basically these fund managers manage in these kind of, the funds. But typically, if you see what these fund managers, they do, they basically play around the various securities, and they play around the duration. So this is the typical management of any of the fund managers, any of the mutual fund managers. Why I am showing it to you? Because when we proceed, we will also showcase how you can portfolio or construct your fixed income portfolio by direct investment. So this is a typical the nature or typical way of managing by the various mutual fund managers. The second the way of participating in bond is the direct bond investment. आप एक तो आपने म्यूचुअल फंड के थ्रू जो है आपने आपने अपने फंड के थ्रू आपने बॉन्ड्स में पार्टिसिपेट किया। दूसरा तरीका ये हो सकता है कि आप डायरेक्टली बॉन्ड में इन्वेस्ट करें, या दो तरीका ये भी हो सकता है, यू कैन मिक्स एंड मैच, सम यू कैन इन्वेस्ट इन सम म्यूचुअल फंड, सम you can also participate directly in bonds. And most of the investors, they basically apply the hybrid model, whereby they basically invest some of the funds in mutual fund and some of the funds directly in bonds. But here the crux, if you basically invest directly in bonds, it is equally and very important for any of the investors to create or to design the system, because it is not about the product that you are just participating in any of the bonds. It is all about how you are designing the framework and how you are basically participating in each buckets. So for example, there are 4 buckets framework which typically any of the investors should basically utilize to construct a portfolio. The first bucket is the liquidity bucket. This liquidity bucket is basically for providing emergency, and this is basically for tactical buffer, because in any of the market, if liquidity is there, you can utilize that liquidity to basically participate in any of the opportunities available in the market, or they may arise in the market. So that is the liquidity bucket. The second bucket is the stability bucket, which is volatility dampener, which will reduce your volatility. Third bucket is basically the yield picker, because here if you invest in some of the bonds, that will provide you some of the yield picker or yield kicker, to your portfolio. Then by doing so, you can capture the spread. And the fourth bucket is basically the cash flow generator, because each investor, they have got their, the cash flow needs. So some of the investor may need, the cash flow next year. Some of the investor may need cash flow next year, or various kinds of the cash flow may be there, various types of cash flow may be there. So depending upon the cash flow, you can basically design your the portfolio of direct participate in bonds, and you can allocate some portion of portfolio can allocate here. Typically for a very, you can say, conservative plus or mild investor who wants to take a mild risk, the asset allocation, this 4 buckets framework, the liquidity bucket should have 10%. This is not we are not casting it in a stone. It depends, it varies from investor to investor. But typically for a mild set of investors who wants to take mild risk, the liquidity bucket should be 10%, the stability bucket should be 40%, yield picker bucket should be 20%, and cash flow generator should be 30% of one's portfolio. So let's create a portfolio of an investor, direct bond portfolio of an investor whose portfolio is 5 crore. So what will we do? As we know that it is, for example, out of the 5 crore, definitely the entire 100% he will not invest in equity and debt. Entire 100% he will not invest in equity. We imagine that roughly 35% is going to debt to provide some sort of a stability to the portfolio. It means that he will invest 1.75 crore in debt. So how will, if we apply this 4 bucket framework, how will he basically allocate his 1.75 crore in various buckets? So the bucket will look like this, and definitely he can utilize this bucket for both the both the participative modes, either through mutual fund or through direct investments in bonds. So liquidity, roughly 17.5%, 10% of 1.75% will go to liquidity bucket. 70 lakhs, roughly 40% of 1.75% will go to stability bucket. The yield picker bucket, which will roughly be 10-20% will be 35 lakhs, and cash flow generator would be 30%, roughly 52.5 lakhs. As I'm repeatedly saying, this is just for an assumption. This is for one class of investor. Depending upon the risk what any individual wants to take, these ratio can change. And probably you can take guidance of your financial advisor, or you can also apply some sort of, the science to basically design the ratio accordingly. So if you are investing in, let's put 10% as a liquidity bucket, the common products are treasury bills and liquid funds, which will generate roughly 6.5% return. The stability bucket, as here, let's put 40% is there. The common tools to basically participate here will be AAA rated bonds or state government bonds. And if you are investing in through mutual funds, then definitely it will be corporate bond funds. It will typically generate roughly 7.5% return. If you are basically providing, applying 20% bucket, you are investing in yield picker bucket, so roughly 35 lakhs will go direct in direct bonds. It will go to AA kind of bond. And in mutual fund, it may go to, the credit fund. So that will typically generate 9% return. Similarly, the cash flow generator here, if you are directly investing in bonds, you can either, create a ladder depending upon the cash flow. Some of the bonds can be in 1 year maturity, can be for some of the bonds can be for 2 years, 3 years, 5 years, maturity, depending upon the cash flow which you want to have in that particular year. Or you can basically identify some of the high yield, the bonds, or you can also, go for through mutual fund, you can go for, the credit risk, the funds. So here, typically the yield mix would be roughly 8% to 10.5%. So roughly, if you see the weighted yield would be 8.5% to 9%, one can generate. So what is more important is rather than chasing, a single securities, if you really create a framework, a scientific framework, depending upon the risk which you want to take, depending upon the need which you have, then that portfolio will be a structured portfolio, and it is superior to chase, the returns blindly. So this is the science, this is the framework which is extremely important. And similar kind of framework, basically, if you invest in equities, right and do the right asset allocation, similar kind of framework you do in equities. I think market is evolving, and I think more and more the awareness is getting created. Investors are getting more informed, and they should here also, basically apply the right kind of framework to basically build the portfolio, to build a structured portfolio, which will basically reduce the risk, which will reduce the volatility, and which will help to basically generate the optimum amount of compounding to one's portfolio. Here, I have just showcased the laddering structure, because this is just an example that if you really want to participate via ladder, then definitely depending upon your cash flow, some of the bonds you can invest in 1 year, 2 year, 3 year, depending upon the cash flow, you can create a ladder and basically participate in direct bonds. So these are the two ways by which, you can construct the portfolio or you participate in fixed income. One is via, directly through mutual funds, or basically directly participating in bonds by creating a right kind of framework, and that's how, you basically create a scientific portfolio. Do you design the portfolio? So hence now I will go to the third pole, So here, before I run the third pole, we have spoken about the mindset, we have spoken about the drawdown, we have spoken about how we can basically utilize the right kind of framework, right kind of science when we participate in, fixed income market, either through mutual funds or through, directly through bonds. So my third pole is, how do you currently invest in debt? Sahil, if you can run the poll. There is no right or wrong answer. I think everyone has got his or her, basically way of participation. Some of you may not be participating in bonds. Some of you may be participating through mutual fund, or some of you may be participating only in equities because of the rally that we have seen post-COVID. So let's answer the question that how do you currently invest in debt? Mostly direct bonds, mostly mutual funds, combination of direct bonds and mutual funds, or there is no structured allocation?
Yes, I'm sharing the results.
Yes, you can share the result.
Yes. So 8% of the attendees have selected A option, 48% of the attendees have selected B option, 23% of the attendees have selected C option, whereas 21% of the attendees have selected D option.
So absolutely right. I think, the 48% they are investing through mutual funds. That is understandably, we can understand this. It is very much we can understand it. But majority, if you see, I think still the combination of direct bond participation is very low. It is only 8%, and that is because the most of the people, they don't have access to bonds, or they don't have understanding of bonds, or they feel that, I think, why to participate in bonds because of the poor awareness, and they basically invest in bank fixed deposits or some of the fixed deposits, while the the reality is that the bonds can definitely get you roughly 50 basis point to 100 basis point, 1% ज्यादा आपको फिक्स्ड डिपॉजिट से ज्यादा रिटर्न देगा. So ये आंसर क्लियरली शो करता है कि and some of the people 21% they don't have the structured allocation. So that clearly says that there is a need to really design the portfolio, whether you are investing through mutual funds or directly in bonds or a combination of the bonds and mutual funds. There is a need of creating a right kind of asset allocation, right kind of a structuring, right kind of bucket framework, to generate the optimum return, to reduce the volatility, and to ensure that your portfolio is giving you the right kind of compounding. अगर आप 2% का भी रिटर्न या 1-2% का भी रिटर्न का फर्क उस रिस्क पे होता है, तो ओवर अ पीरियड ऑफ द लॉन्ग रन it has got a big difference in compounding benefit. So yes, Sahil. So what does it mean that yield without understanding risk is speculation? The structure and framework becomes more important. The returns, if you chase returns, that is not right. When we were talking about the construction of portfolio, either through mutual funds or directly through bonds or combination of mutual fund and bonds, it is very important for us to understand the risk associated with various mutual funds, risk associated with various bonds, then the risk that any investor can take, and then map that risk with right kind of framework to generate right kind of the return, to ensure that your portfolio is giving is less volatile and giving you're giving right kind of the compounding over a period of in long run. So now I will run the fourth poll. Yield versus safety, what attracts you most in fixed income? Because हमने ये सारे मैंने एक फ्लो जो आपको बताया कि आप नॉर्मली इन्वेस्टर्स पैनिक करते हैं, नॉर्मली इन्वेस्टर्स ड्रॉ डाउन को नहीं समझते हैं. पोर्टफोलियो में अगर आप 10 से 12% का रिटर्न ओवर अ लॉन्ग पीरियड ऑफ टाइम पोर्टफोलियो लेवल पर बना रहे हो, दैट इज सुपरलेटिव काइंड ऑफ वर्क एनीवन इज डूइंग. राइट काइंड ऑफ फ्रेमवर्क इज extremely important. Right kind of portfolio construction is extremely important. So your fourth poll, just to understand what you do and what and you chase yield, or you chase safety, or you really create a right kind of framework. So what attracts you most in fixed income? A capital safety, a predictable income, high yield, and liquidity. So Sahil, if you got the answer,
Yes.
you can.
So I shared the results that 57% of the attendees have selected A option, 21% of the attendees have selected B option, and 17% of the attendees have selected C option, whereas 5% of the attendees have selected D option.
So still, if you see, there is a scattered answer. Some of you may be investing in, maybe chasing, fix, higher yield. Some of you may be investing only for liquidity. Some of you may be investing only for capital safety, or some of you may be investing in predictable income. But fact of the matter is that there is no right framework which any of the investor applies. So let's go ahead. Sahil, you can just close the poll. So it means that there is a place for definitely bonds. And some of you answered that, it is because of the high yield you invest in fixed income or bonds. But bonds are not about maximizing return. Bonds are basically to engineer a portfolio in such a way that it should provide stability to the portfolio. Once we understand that, then it is very important for us to really construct and design the portfolio in a rightful manner. So if we do so, I think we have got limited time now. So if we do so, I think there is a place for fixed income which can provide balance and growth. So that basically, is a great lever which basically reduces the drawdown. It provides you risk-adjusted returns. It helps you in rebalancing your portfolio. Definitely, it provides the right kind of, the income, which is basically for if any one of the investor, he wants regular income, that is one source of, a product which basically can provide a regular income. And definitely, it also helps you to control your behavior, because if you have got limited drawdown, you will not do the panic. So that is the basic, the basic, duty or basic, role of, the bonds in one portfolio, which will basically provide you a sort of a stability. So while we have spoken about all these things, it is equally important to understand that how we can basically solve the problem. So through bond view, as you know, that we are one of the online bond platform, and most of you, while I was presenting it, you may not be knowing, from where you can buy or sell bonds. Definitely, most of you understand, about mutual fund, and but about bond, no one knows. So this is basically the problem which we are solving through bond view, and there are various, the problems which are there in bond market. So through bond view, we are simplifying the bond discovery. We are ensuring that there should be a transparent yield, risk, and cash flow visibility. We are also ensuring that the knowledge gap can be bridged, because knowledge about equity is there, or I will say that equity, because market has done well, so there is awareness about equity, but there is poor awareness about fixed income. We want to empower various class of investors and advisors, and we also want, when I was presenting, we want to help you to really construct the portfolio. So through bond view, we basically want to solve these problems. So what we have done, we have basically aggregated 28,000 bonds available in Indian market. We aggregated it, and we just curated it in a manner that whatever kind of bond if you want to select, अगर आपको 5 साल का bond चाहिए, 3 साल का bond चाहिए, किसी rating का bond चाहिए, there are filters. You basically select the filter and identify the bonds, and not only identify, you can basically see the cash flow, and you can transact from there itself थ्रू जो एक्सचेंज के आरएफपी प्लेटफॉर्म है, उसके थ्रू आप डायरेक्टली वहां पर आप बाय सेल कर सकते हो, जैसे आज के डेट में आप इक्विटी में करते हो. दिस most of the investors, I'm not talking about some of the participants who are there maybe knowing it, but most of the investors, they are not aware about where to go, how to identify, how to search for bonds, how to the buy and sell. So these are the basic problems any investors are facing, and we are trying to solve it. You can also construct your portfolio through bond view. Whatever the portfolio you have, you can basically upload your portfolio, see your portfolio, and see whether your portfolio is rightfully constructed or not. So this is the third problem that we are solving. The fourth one is also important, because as I mentioned, that there is a poor awareness about bond market. So through Learning Hub, we have got a free Learning Hub on our platform, where any one of you can go and basically learn about the foundational do the foundational course and learn about the basics of fixed income market. Once you graduate, you can go to basically learn about intermediate section, and then you can become the expert. There are various question and answer जो कि आप वहाँ पे answer करके आप, it's a self-learning module, you can learn it, So this is the fourth problem that we are solving. So while I think I just want to summarize what I spoke, I think in 45, 50 minutes in simple manner, if how I can communicate the fixed income to you is important. So we spoke about the mindset, we spoke about drawdown, we spoke about how you can basically create a portfolio whereby you can reduce the volatility. We also spoke about how you can construct the portfolio either directly participating in bonds or indirectly through mutual funds. And we also spoke about, basically how fund managers are utilizing various levers to manage the funds. And we spoke about the right kind of framework, which is very, very important for you to really design the debt portfolio also. The framework most of the investors are utilizing in equities, I believe so. But as when it comes to fixed income, so if you have got 100 rupees, 35 rupees, 30 rupees, depending upon the age bracket in which you are, depending upon the risk which you want to take, you can, if you are allocating to fixed income, there should be science to really manage that 35, 40 rupees too. And if you do so, you will be in a better position to basically manage the portfolio and reduce the drawdown and ensure that your portfolio is generating right kind of compounding. So with this thought, I am just pausing it. We have got 10 more minutes. I'm just opening it for question and answer. If you have got any question and answer, you can ask. And I will ask my colleague, to basically, if they want to, they can share the link. So any one of you, if you want to join the community, you can join. Here, the basically various QR code is there. You can basically go there and just learn about it. The whole idea is basically to ensure that you should have a right kind of, the learning, right kind of, knowledge, and which you can simplify and which you can apply in your, the portfolio construction. So over to you, Sahil. If any one of you, any one of the, the participants, if they have got question, they can ask.
Yes, sir, there are few questions in Q&A section, which is close to share option down below. Like there are
Can
nine. Okay,
can
okay,
you?
I will read it out.
Yeah, you can read it out.
Yes, so Pradeep is asking that how much can be the differentiate in yield if we invest through mutual funds or invest directly?
You see, the if any retail investors is there, whose investment is limited to 4 lakhs, 5 lakhs, then definitely mutual fund is the right kind of vehicle, because you get the diversification, you get liquidity. But if you have got large chunk of money, then definitely some portion of your money should definitely go or should also participate directly through bonds. So if you really curate your portfolio or design your portfolio in a better manner, then at least my assumption is that at least you can generate 1%, 1 to 2% more return than mutual funds, because mutual funds, they invest in 50, 60 securities. They have got diversification in place. Here you can concentrate your portfolio. Mutual fund managers, they have they can only invest in AAA rated and G-Secs in normal, the bonds. Here you can participate in some of the high quality high yield bonds too, or some of the AA minus kind of bonds whose credit is equally good. And if you do so, and if you really design it well, you can generate roughly 1% to 2% more return than mutual funds. But that is just I'm just giving you a framework. It is not the guarantee, it's just a framework. Yeah.
Thank you, sir. So next question is from anonymous attendee, and the question is he needs some more information regarding secured and listed bonds.
So as I mentioned that if you want to know more about secured and listed bonds, uh, there are various online bond platform. We have got our online bond platform that is called BondView. You can go to www.bondview.com. You can just create your login credential and search there. There's a right kind of curation is there. You can get right kind of the information which will really help you to know more about the secured, listed, and all kinds of bonds.
So next question is that what is advantage and disadvantage of direct bond investment?
No, disadvantage is the advantage is the liquidity. Disadvantage is liquidity because typically, if you're participating or directly investing in bonds, all the bonds are not liquid, and that is the reason why the Security and Exchange Board of India, government, various stakeholders, including OBPP, we are ensuring and creating right kind of knowledge and creating awareness and creating a distribution framework, distribution network to create a liquidity. In this budget also, if you must have seen that a liquidity framework has been announced, and probably I think it will take some time to create the right kind of liquidity in bonds. So that is one disadvantage. Advantage is definitely, you can design your portfolio as per your choice. So if you really want 10% return, you can pick and choose, do some sort of the analysis, the credit analysis, and participate and design your portfolio as per your need, as per your cash flow.
The next question is that Sridhar is asking, I have regular contributed to the EPF corpus. Do we still need to be build a debt portfolio?
So it is not about, as I mentioned in the presentation, it is not about building only debt portfolio or building EPF portfolio. EPF is typically sort of the debt portfolio itself. So what you should do, you should have a right kind of, as I have been repeatedly saying, that right kind of the framework where first you define your need, then you define your asset allocation. Under asset allocation, if it is, let's put equity, you participate through mutual fund or directly through equities. If it is fixed income, you participate again through mutual fund or directly through bonds. So it is all about the creating a framework. I request and urge you not to have an ad hoc mechanism where you just for the sake of participating in fixed income or bonds, you participate. You create a framework. The framework should be completely on the basis of your risking ability, your goal, and other things. And accordingly, you create the allocation framework, you create a right securities framework, right bucket framework, and then you design the portfolio. And in case you are finding any difficulty, definitely there are advisors, there are basically your advisor, you can seek help of those advisors who can really help you out. But I'll really urge you to have a right kind of framework which will create a right set of generate a right set of our optimum return, and which can create right kind of the compounding to your portfolio.
Thank you, sir. Then I can see most of the questions are related to the other thing, but wait. So the next question is that a rated corporate bond is good to invest or have any difficult risk?
No, if it is rated as I mentioned that there are various kinds of rating. It starts from sovereign rating to AAA rating, AA plus, AA. So there are rating agencies that there are rated. Typically, all the bonds are, there are definitely unrated bonds, but there are typically majority of the bonds, 99% of the bonds are rated. And if it is rated, and you can also do some sort of the analysis, and then you can participate in rated listed bonds. And where as I mentioned that you have got various OBPP platform, online bond platform, where you can go and we are one of them. You can go and just search and then do the need.
Yes. So there are most of the questions which are related to investing, like which is better and which is not. So we're not gonna take those
Yeah.
questions.
Mhm.
So, sir, until that time, because we have still 5 minutes left, so you can touch upon key highlights or key takeaways that attendees should remember.
So, yeah, no, thanks, Sahil. I think the key highlights, as I mentioned in the beginning of the presentation, ये जो सीरीज हम लोग रन कर रहे हैं, वो सीरीज हर सीरीज एक दूसरे का सिक्वल है. जो पहला सीरीज हमने जनवरी में रन किया, वहाँ पर वी स्पोक अबाउट बेसिकली द माइंडसेट, वी स्पोक अबाउट द वोलेटिलिटी, वी स्पोक अबाउट व्हाई देयर इज अ प्लेस फॉर बॉन्ड इन वंस पोर्टफोलियो. वो पहला हमारा सेशन था. जो दूसरा सेशन आज जो हमने किया, वहाँ पर हमने ये बात किया कि अगर बॉन्ड का आपके पोर्टफोलियो में डेफिनेटली देयर इज अ प्लेस of bond in your portfolio or fixed income in your portfolio. Most of us basically do mistakes by only investing in equities, or even if we are investing in uh, equity and debt put together, there is no basically science behind it. So I will urge each one of you, और जो हमारा जो मेन जो थे ये था कि कैसे साइंटिफिक फ्रेमवर्क हम फिक्स्ड इनकम में भी बना सकते हैं. अपने इन्वेस्टमेंट जर्नी में एक फ्रेमवर्क बना के हम इन्वेस्ट डायरेक्ट या थ्रू म्यूचुअल फंड कर सकते हैं. दैट इज वेरी इंपॉर्टेंट. जो हमारा ये सेकंड सेशन था जो इसका हाईलाइट था. थर्ड जो सेशन जो हमारा होगा, वहाँ पर हम ऑप्टिमाइजेशन की बात करेंगे कि कैसे हम टैक्स को ध्यान में रखते हुए अपने पोर्टफोलियो को बनाएं, और वहाँ पर फिक्स्ड इनकम का क्या पोजीशन होगा. और फोर्थ जो हमारा अप्रैल में जो होगा, वहाँ पर हम लोग गोल बेस्ड इन्वेस्टिंग की बात करेंगे. हाउ बेसिकली यू कैन यूटिलाइज फिक्स्ड इनकम instrument or fixed income asset class as your as a goal based investing. तो ये सारे जो चार अगर जो चीज हैं उसको अगर आप होलिस्टिक तरीके से if you really see it, then it will really be a great help to each one of you, because that is a real investment. So आज जो हमने बात किया वो सेकंड सीरीज का सेकंड पार्ट था, जहाँ पर हमने पोर्टफोलियो कंस्ट्रक्शन की बात की. ये जो लिमिटेड समय में वॉट एवर वी कैन स्पीक इन अ सिंपल मैनर, द क्रक्स इज द डिजाइन, द अप्लाइंग द राइट फ्रेमवर्क, राइट बकेट, डिजाइनिंग इट साइंटिफिकली, and attaching it with your risk taking ability, your cash flow, your time horizon. And if you really do so, then probably I think that is a right way of the creating the portfolio. सो ये हमने आज बात किया, यही हाईलाइट है. अगर आप चारों सेशन को एक दो तीन चार चारों सेशन को जब आप होलिस्टिकली देखोगे 4 सेशन के बाद, देन डेफिनेटली यू विल रियली फील दैट आई थिंक कि ये जो चार जो पार्ट हम लोग इस वेबिनार को 4 पार्ट में कंडक्ट कर रहे हैं, each part is related to the previous part, and that will give you a holistic view about not only about fixed income but about your investment and your asset allocation. So that is the crux of the webinar and the presentation side.
Yes, thank you, sir. I think we have if there are any questions are remaining. I think we have answered almost most of the questions which were asked by the attendees. And as I mentioned earlier, other questions are related to investing and which is better. And
So you can note down all the questions if you have,
sure.
and I think mm, um, the participants can basically, we have already circulated. I'm just showing this QR code. They can just go and just, if they really want to learn, they can go to our website, they can go to our learning hub and learn more about it. So thank you, Sahil, and thank you, NISM team. Yes, Sahil.
Thank you so much, sir.